Dog just finished a 40-hour week of being a very good boy, but instead of enjoying his reward, he's buried under a mountain of raw earnings and crumbled paper. He has no way of knowing how many of these bones he actually gets to keep. We are going to change that. This guide will show you how to organize these materials, identify your legal deductions to lower your taxable income, and calculate your exact liability so you can stop guessing. To follow along, you'll need your total earnings statement, like a W-2 or 1099, a calculator, and your pile of work-related receipts. Categorizing these raw materials is the essential first step. Without this organization, there is no way to distinguish your business costs from your actual profit, leaving the counsel to count every single bone as taxable income. We start with your gross income. This is the total number of bones you earned this year, before any outside systems take a slice of the pile. A portion of this pile is set aside for income tax. This is a mandatory contribution used to fund the neighborhood infrastructure that individual dogs couldn't build on their own. These pooled bones pay for the fences at the dog park, the neighborhood guard dogs who keep the squirrels in check, and the maintenance of the communal fire hydrants. While these community services are necessary, your goal is to ensure you are contributing only the legal minimum. To find that number, we have to look at what is actually taxable. This is where we define taxable income. This is the specific portion of your earnings the counsel is allowed to tax, and it is often much lower than your gross income. To lower that number, you must separate your business-related expenses from your personal ones. Only the costs required to do your job can be used to reduce your tax bill. If you run a freelance bone-burying business, your personal squeaky toys don't count. But the heavy-duty titanium digging shovel you bought for your client work is a standard acceptable write-off. This diagram shows the math in action. When you record that 5-bone shovel as a business expense, the system treats it as if you never earned those 5 bones at all. Your taxable total drops from 40 down to 35. Lowering this baseline is the most effective way to reduce your liability, as it shrinks the amount of money the tax percentages can touch in the first place. Now we have to address the most common fear in finance. Many dogs believe that if they earn a raise, the higher tax bracket will take so much that they'll end up with less take-home pay than before. This logic is flawed because it assumes the tax rate moves as a single flat percentage across your entire income. To see how it really works, we have to look at the containers. The counsel uses a progressive tax system. Think of this as a series of buckets with specific volume limits. Your income fills these buckets one by one. The first 10 bones you earn fill bucket 1. The label here says 0%, meaning you keep every single one of those 10 bones. If you earn more, the overflow moves into the second bucket. The 10% tax rate only applies to the bones inside this second bucket. The first 10 bones in the bottom bucket remain completely untouched by this higher rate. Because the higher percentage only touches the overflow, every extra bone you earn results in a net gain. It is mathematically impossible to lose money by accepting a raise. Eventually, a refund check arrives in the mail. It's easy to feel like the counsel just gave you a windfall or a spring bonus. To understand what this check actually is, look at your paycheck withholding. Throughout the year, the counsel takes an estimated prepayment of your taxes based on a guess of what you will owe at the end of the year. This chart compares those estimated payments against your actual liability. If you receive a refund, it simply means your prepayments were higher than your actual bill. The counsel is just returning your own change. A large refund means you gave the system an interest-free loan all year. You can adjust your withholding status to keep that capital in your own pocket where it belongs. By sorting your deductions, calculating your overflow through the bucket system, and auditing your refund, you've turned a chaotic pile into a structured plan. The uncertainty of tax season is replaced by a clear view of how your earnings move through the tiers, and the fear of the next bracket is gone. You now know the mechanics of your own money. Take a moment to acknowledge that you've mastered the hardest part of the process. Let me know in the comments which complex financial system we should break down next, whether it's credit scores, mortgages, or something else.